Good day, guys. Welcome to Julius Academy. And our topic for today is ledger account. All right, so ledger slash principle of double entry, but it's mainly ledger that I'll be talking about. All right, so now what are we going to be discussing in this our topic for today is we'll talk about what ledger is, importance of ledger, types of ledger, types of accounts, and application of principle of double entry to our ledger. So now, before I proceed, I want to let you guys know that ledger is like the backbone of financial accounting or any accounting that you are dealing with because you will need the ledger for it. So now, what's ledger? Ledger is an account. They can call it a principal account that contains permanent record of your assets, your liability, your income, your expenses, and your owner's equity. So ledger is talking about keeping the account of your element of your financial statement. That's what ledger is what talking about. So that now that you know the definition of ledger, what are the importance of ledger? You understand? So importance of ledger means they keep permanent record of element of financial statement, which is assets, liabilities, income, equity, income and owner's equity rather. So they provide relevant information that is necessary. They provide relevant information that is necessary for what? Preparation of what? Financial statement. But for the scope of basic accounting process, I said we'll be only preparing what? Statement of profit or loss and statement of financial position. So yeah, this is where we'll be getting our information from. You understand? So another thing that you need to take note of is that they give origin of every transactions and the parties involved. Yeah, so they show the root of every transaction and where it comes from. Now, another thing is the information at the end of the ledger account is what we will make use of in preparing our trial balance. So we can also say ledger is a principal book in which we record information from subsidiary books before posting them to us or before transferring them to us to their trial balance. You understand? So now we have types of accounts. Types of accounts, not ledger. So don't mix it up. Types of account is different from types of ledger. Types of account. So now we have, according to basic accounting process study text, they said you have three. That is, we have personal, real, and nominal account. But you can also put it this way: account. We have personal and impersonal. So this impersonal is divided into what? Real account and what? Nominal account. So yeah, personal account, it is the type of account that we use to record credit transactions, purely credit transactions. So we use to record account of our receivables or debtors and our payables. So that's what we purely use it for. You understand? So that's what we use that from the word personal. It has to do with individual. It's used to record individual accounts, be it customer or your suppliers. Now for impersonal account, of course, it is non-personal. In the sense that we need to record real and nominal accounts. Real in the sense that you can see it, you can touch it. You can see there are accounts for recording tangible items that can be seen, felt, touched, or moved sometimes. So example of that is simply our inventory, our non-current accounts such as our plant and machinery, property and equipment, motor vehicles and the likes. While our nominal account is simply talking about non-tangible, something you can't see and touch. So mainly income and expenses. So that's what our nominal account is being used for. It is to record our income and expenses because they are items that you can't see and touch. Now, types of ledger, according to our study text, types of ledger. So we have four types of ledger. We have our sales ledger, or they call it trade receivables ledger. We have our purchases ledger. We have our private ledger, and we have our general ledger. So you can also call this payables ledger. So our sales ledger serves just one purpose, and that is our sales ledger is for what? It's for recording what? Credit transaction. It is used for recording debtors accounts, that is customers account. You understand? Both your sales ledger and purchase ledger are used for what? Credit transactions only. So sales ledger is for what? Customers. It's used to record customer transaction with customers that bought goods from credit. While purchases ledger is used for what? Recording credit transactions with our suppliers. So now, where do we get information from? We get most of this from our sales day book. You understand? When I drew the diagram, although you get to understand it when I solve a full standard question, that is, I call it the accounting process from subsidiary books up to our tribunals. Then you will see how this link to each other. So this is coming from our what? Sales day book, or call it our sales journal. Then purchases ledger, which we use to record credit purchases. You understand? This is coming from purchases day book. The information here from our comes from what? Purchases day book. And that's where we get our information that we post in our what? Purchases ledger. They are both what? Personal accounts. So yeah, personal accounts mostly falls into these two. Now for private ledger is simply talking about your capital account, investment account, drawings account, and loan account. Although you don't usually get to present this to the public most times, so it is usually have the access to it belongs to the senior manager. Yeah, then every other one falls what? Under general ledger, that is our real and what? Our nominal account, such as our assets, our non-current assets, our current assets, other than receivables, then our income, expenses, and the likes. So yeah, because I don't want to take much time because this is just theoretical aspect. So this is basically all that we need to record. So your assets, your cash book, your sales account. Now sales account is not the same thing as sales ledger. They are two different things, but you get to understand when we solve a standard question. Now another thing I need to know before I wrap up this class is our principle of double entry, because yeah, this is where we'll be applying it the most. So our principle of double entry, like we all know, is states that for every transaction, for every debit entry, there must be a what? Corresponding credit entry, and vice versa. Yeah. So what does that mean? You debit the receiver or the receiving account or the incoming account. Yeah. You debit the receiver and you credit the what? The giver or the giving account. Now that is how what double entry is talking about, regardless of the element of financial statement. Yeah, I repeat it, regardless of the element of financial statement. You debit the receiver, you credit the giver, regardless. So once you know this, then you won't start confusing yourself, because there might be some transaction, or let me say some liability transactions, that the liability is the liability account will be receiving, you understand? So in that case, you'll be debiting the liability because it is the one receiving. For example, let me give you another clue that will help you. So now, that is, in aspect of our element of financial statement, you debit all expenses. So what does this mean? Our expenses automatically have a debit balance, our assets, and whenever we make loss, or let me call it losses, yeah, you debit all the expenses, assets, and losses. That's the natural balance, but it does not mean that if they give, you won't credit them. That is why this will override the natural balance of this. Just understand this very well. I'm going to give just one example, just for you to have one or two examples rather, just for you to have an understanding of this. Then here you credit what our liabilities. That is the credit balance, your income, and your what profit. Not necessarily profit, could be gains, profit or gains. You understand? Try to understand this. You can jot this down in your notes so that you can understand what ledger and principle of double entry is all about. If you can get this aspect very well, I'm going to spend much time on this when we get to our main calculation or questions for us to solve. I will dwell more on this and take my time to explain this well so you can understand the concept properly. Then once we do that, then we can now move to every other transactions or every other topics for you to understand. Now another key point that I want you guys to know. So this will also help you in case you are doubtful, because like I said, I believe you guys are young accountants and you are just coming up. So you will need to know this. Now, okay, let me put it this way. Debit. And I could have just dictated this, but I decided to write this for reasons best known to me, and I suggest you guys do the same in your notes. So when you debit increase in what assets, increase in expenses, then when there is a decrease, this is one option one, this points to this point 3. Decrease in what? Decrease in what? Liability. Liabilities. Decrease in income, then decrease in owner's equity. Alright, let me rule it this way so that I can separate the points from each other. Whether you know this or not, if you understand this principle of double entry, whereby you debit the receiver and you credit the giver, or the receiving account or giving and credit giving account, you might not even need to memorize this. And I'm not encouraging you to cram, but it's just for you to broaden your understanding on double entry. So if this is increase in assets, then if you are going to credit it, then it's going to be what? Decrease in assets. So you credit decrease in asset. When you dispose an asset, you credit it. You understand? It reduces your balance in your an asset account. Then when there's a decrease in what? Expenses. For example, when you pay part of the expenses, you credit it, so it reduces. Then when there's an increase in your liability, you credit it as well. For example, when you purchase goods or when you buy more goods from your suppliers on credit, yeah, it will increase your liability, your payables. You understand? So it will be on the credit aspect, credit side rather. Then when there's an increase in income, yeah, you credit it. Now you might not understand this, but well, but when you remember when we were still using our T format, when you have the debit side by the left, credit side by the right, you observe these things well. You understand? Even though vertical format is the only accepted format according to the standard ICAN gives, you have to use vertical format. But you can still make use of your horizontal format in learning, just to grab this thing well. I might be making use of it along the line just for you to understand. I'll make use of both. My use of my horizontal format, that is T format, is for you to understand this concept well. Then the last part is what? Increase in owner's equity. Yeah, when you bring in more more cash, when you introduce more money to the business, might not necessarily be money, it can be in form of an asset too. I will explain all this when we get to standard question. When you introduce an asset, anything you introduce to the business becomes an increase in what? Owner's what? Equity. Now let's solve just one question on this so that you guys can understand what we are doing. Alright, so let's solve a question. Now, when you are given a question, regardless of whatever you are solving, the first thing is to identify the type of transaction that it is. So step one, you identify the type of transaction that you are dealing with. Is it cash transaction or credit transaction? So looking at this alone tells us that what? It is a cash transaction. Now when you are dealing with cash transaction, you won't need to include the name of any enterprise. You understand? Because it is a cash transaction, so you don't need the name. So this is a cash transaction. Now step two, identify the account involved. So what are the accounts involved? I would have said Adeolu Enterprise and Cash, but because it is a cash transaction, so we don't need what? The name of our enterprise, because this is the name of the business, definitely. So it is motor car and what? And cash. So these are the two accounts involved, motor car and what? Cash. Now step three is identify the receiving account and the giving account. So now you are preparing this account from the perspective of Adeolu, which is the name the enterprise. So Adeolu purchase a motor car. So when you buy a motor car, when you purchase a motor car, you receive the motor car. You understand? So motor car received. Then for 750,000 cash, that is you paid cash, cash given. So step four, or let me just call it the last step. You debit the receiving account and you credit the giving account. So motor car is receiving because motor car is coming into Adeolu Enterprise business. So therefore you debit motor car and you put the amount 750,000. Then you credit what? Cash with the same amount. That's all. If I were to draw my T format for it, on my motor car account, I'll put what? I'll debit it with 750,000 naira and put in my cash as the particular. Then on my cash account, I'll credit it as 750,000 naira and I'll put motor car as what? My particular or my details, whatever it is. Now, solving double entry question is not limited to just two accounts. There can be more than two accounts in a transaction, but at least the least there is also two. So you can have more than two accounts in your double entry question or in your accounting question. So it is not limited to what? Two questions. Alright, so I would love to put an end to it because I'm sure in every point and every details that I give is going to help you understand and grab the concept behind what? Double entry principle or ledger account. Alright, so this is where I'll be stopping for now. If you have any question, kindly engage write it in the comment section and I will attend to it. Kindly like, subscribe and turn on your notification bell so that I can get notified whenever you upload subsequent video. See you in our next class. Thank you.